Hi, welcome to Newbie Guide to REITs Analysis, and in this chapter, we'll look at the cost of capital versus a cap rate and why this is a very important concept to determine whether or not a REIT is able to make accretive acquisitions that leads to inorganic growth in the DPUs. Let us assume a cost of debt of around 3% for the REIT and a cost of equity of around 6%. So, in general, I think the long-term stable gearing for a REIT should be around 36%. There should be periods where the gearing rises, and there should be a period where the gearing goes down, especially after a capital raising exercise. But in general, I think this is a long-term stable gearing that the REITs should be trying to maintain. So if a REIT is around 40% geared, that is normally too high, and over time it needs to come down, especially during times of trouble. So assuming these three factors, the cost of capital for the REIT should be around 36% times 3 plus 64% times 6, therefore 4.92%. So a stable gearing of 36% just means that out of 100% of assets, 36% of it should be funded through debt, and the rest, meaning 64%, through equity. Therefore, it comes out of this kind of a formula. So the significance of this calculation means that the cost of capital for the REIT is around 4.92%. So therefore, any acquisition with a cap rate of less than 4.92% is clearly destructive. So for the conservative investor, you should be looking at the capital structure of the REIT, meaning what is effective cost of capital, and then look at the target acquisitions that the REIT has, the asset class, be it retail, industrial, hospitality, offices, commercial, and so on and so forth, and the geographies that it operates in. And therefore, look at the general trend of the cap rates of the assets in the different geographies, and whether or not the REIT is able to make any significant acquisition with a decent cap rate above and over the cost of capital. Because if the REIT is only able to buy assets yielding around 6%, but the cost of capital is more than 8%, then clearly there cannot be any way the REIT can achieve any decent accretive acquisition. In that case, the logical conclusion would just be to sell and go away. The traditional calculation of the cost of capital utilizes the CAPM model, so the capital asset pricing model, which comes with a formula that looks like this. I think the problem with this approach is that if you use the formula, you have to come up with this beta, and therefore that's the sensitivity to the market returns. In general, I find this to be a bit of what I call the black hole of finance, where you have a rubbish input and therefore you come up with a rubbish output. And sometimes even more undesirably, some people target to achieve a certain number for this fella, and therefore reverse engineer to come up with the beta required to come up with this number. So in general, I'm not a big fan of this CAPM model used to calculate the cost of capital for REITs, and I just use the market-based calculation, which is the current share price and the current DPU, and therefore the expected yield on the equity as a proxy for the cost of capital. So let us use this example of using the Capital Land Ascendance REIT as an example to come up with an analysis of the cost of capital versus the cap rate. So first of all, we can look at the cost of debt, and it's quite stable around 3.3%. That of course comes because it has an A3 rating from Moody's. Next, we look at the cap rates that the Ascendance REIT has. You can see that the weighted cap rate is around 5.8%. Look at it, it's a bit of a spread because of the geographical exposures it has. So, Australia properties come with a 5% cap rate, and you have a pretty high cap rates in the US and the UK portfolio of around 6%. So let's think about the cost of capital that the Ascendance REIT has right now. Given that the current share price and the current DPU, this comes out to be around the cost of capital around 6%. So if you look at it, 36% times 3.3, which is the cost of debt, 64% times cost of equity, which is around 6%. This comes out to a nice number of 5%. So you can see that the even in this current environment, the cost of capital for the REIT is around 5%, and even at this level, you're still able to make accretive acquisitions in Singapore, in the US and in the UK and Europe. So therefore, I would say that the REIT deserves to trade at around book or even slightly above book, because even at this current funding structure, it's able to make accretive acquisitions in 3 geographical locations across asset classes. For the conservative investor, you might just want to overstate the yield on the equity, because let's say the yield trades around, let's say the REIT trades around 6% dividend yield currently, but if the REIT needs to raise equity, be it a placement or through a rights issue, then normally there needs to be a discount to the share price, and therefore what is a current 6% yield on the equity might come out to be around 6.5 to even 7% when the time comes for the actual equity raising. So for the conservative investor, you might just want to raise this number for a bigger margin of safety. But as to how much margin of safety you should employ, it really depends on track record of the REIT ability to raise equity in the markets, to be it the retail investors or to the institutional investors. Therefore, quite a lot of work, but the conservative investor should be well advised to look at the track record of how successful they are, the REIT is able to raise equity, and therefore estimate the number for the cost of equity.